Robert is 74 years old, a retired machinist from Ohio. 35 years, he never missed a contribution to his IRA. $500,000, built one paycheck at a time. In 2025, Robert turned 73. His advisor told him something that sounded like a gift. You don't have to take your first RMD this year. You can wait until April 1st of next year. So Robert waited. What nobody told Robert is that waiting doesn't erase that withdrawal, it just moves it. Right next to a second one that's already scheduled. Due December 31st, same year. 2 mandatory withdrawals stacked on top of each other, 1 tax return, and Robert has no idea it's coming. By the time he sits down to file next spring, he's going to owe the IRS more money than he's ever owed in his life. And he did everything by the book. The lawyers want me to remind you this isn't financial advice. It's a warning. So treat it like one. This is education, and the specifics go to a professional who actually works for you. Now, let's break down exactly how the IRS turned Robert's extension into a trap and how you can avoid stepping into it yourself. Here's who's already standing where Robert is standing. If you turned 73 anytime in 2025 and you took that extension, delayed your first withdrawal past December 31st, this is already loaded and waiting for you. It hits on your 2026 tax return, not someday, this year. And if you haven't turned 73 yet, don't relax. This is coming for you too. Under the current rule, 73 is the trigger age if you were born between 1951 and 1959. If you were born 1960 or later, the IRS pushes it to 75. But the trap works exactly the same way when you get there. This video is for both of you, the person about to get hit and the person who still has time to sidestep it completely. And here's what makes this so infuriating. The IRS doesn't call this a penalty. They don't call it a trap. They call it an extension, a favor, something they're doing for you. Type your birth year in the comments right now. I want to see how many of you are standing exactly where Robert stood 18 months ago and didn't even know it. Because the mechanism behind that favor is where this gets ugly. Let's go there. Let's walk through exactly how the IRS calculates what Robert owes, because when you see the 2 numbers sitting side by side, you understand why this is so dangerous. Start with RMD number 1, the one he delayed. The IRS takes his IRA balance from the end of the year. He turns 73 at $500,000 and divides it by something called the life expectancy factor. At age 73, that factor is 26.5. So 500,000 divided by 26.5. That comes out to $18,868. That's what Robert was supposed to pull out by December 31st of 2025. Instead, he pushed it to April 1st, 2026. Legal. Allowed. The extension. But here's what the extension doesn't do. It doesn't cancel RMD number 2. It doesn't pause it. It doesn't even know it exists. RMD number 2 is calculated completely separately off his balance a year later, divided by the next factor, the 25.5. That comes out to $19,608. And that one is due December 31st, 2026. No extension, no delay option. It was always going to land in 2026. So now look at what actually happens in Robert's 2026. RMD number 1, the one he thought he was being smart by delaying, lands in April. $18,868, and RMD number 2 lands in December. $19,608. Add them together. $38,476 of taxable income in one calendar year on one tax return. Now stop and compare that to what should have happened. If Robert had just taken his first RMD on time in 2025, the year he turned 73, EQs that his 2025 return shows one withdrawal, $18,000. And his 2026 return shows the other one, $19,000. 2 separate years, 2 separate manageable tax bills, Nothing stacks, nothing spikes. That's the whole trap in one sentence. The extension didn't save Robert a withdrawal. It just took 2 years worth of taxable income and crushed them into one. And I want to be very clear about something because some people hear this and think the smart move is to just not take it at all. Do not do that. The penalty for a missed RMD is 25% of the amount you were supposed to withdraw. Catch the mistake and fix it within 2 years, and it drops to 10%. And it used to be worse. Before 2023, that penalty was a staggering 50%. So skipping the RMD isn't the escape hatch. Skipping it is how you turn a tax problem into a penalty on top of a tax problem. The escape is understanding the stack before you're standing in it. Because $38,000 of income landing in a single year doesn't just bump Robert into a higher tax bracket and stop there. It reaches sideways into a check he thought the IRS had no business touching, his Social Security. Here's the part almost nobody explains, and it's the part that turns a bad year into a disaster. Most people believe their Social Security is theirs, tax-free, untouchable. It is not. The IRS decides how much of your Social Security gets taxed based on a formula. And Robert's 2 stacked RMDs just walked straight into that formula and set it off. The formula uses something called combined income. That's your regular taxable income plus any tax-free interest plus half of your Social Security benefit. And there are 2 thresholds that matter. For a single filer, cross $25,000 of combined income and up to 50% of your Social Security becomes taxable. Cross $34,000 and now up to 85% of it is on the table. Here's the outrage in those numbers. They were written in 1983 and 1993, and they have never once been adjusted for inflation. $25,000 meant something very different back then. Today, almost every retiree with a pension and a paid-off house blows past it without trying. Let me put Robert's actual numbers into that formula so you can watch it happen. Say Robert collects $24,000 a year in Social Security and $20,000 from a pension. Before the RMDs, his combined income is his $20,000 pension plus half his Social Security, $12,000. That's $32,000. Over the first threshold, but manageable. Now drop the 2 stacked RMDs on top, $38,000. His combined income doesn't creep up. It rockets to around $70,000, so far past the 85% threshold that the maximum amount of his Social Security is now taxable. 85 cents of every benefit dollar taxed right alongside the RMD's money he thought was safe. And here's the mechanism financial planners call the tax torpedo. Inside that zone, every extra dollar of RMD income doesn't get taxed just once. It also drags 85 cents of Social Security into the taxable pile behind it. $1 of RMD creates $1.85 of new taxable income. So if Robert's in the 22% bracket, that stretch of income isn't really taxed at 22%. It's taxed at closer to 40% on a retiree living on a pension and Social Security. Not a millionaire, Robert. And even after all that, the IRS isn't finished because there's one more bill, and this one doesn't show up this year. It shows up 2 years from now, and by the time it lands, Robert won't even remember what caused it. It's Medicare. Your Medicare premium isn't a flat number for everyone. Above certain income levels, they add a surcharge called IRMAA. And here's the cruel part. IRMAA looks back 2 years to set your premium. So the income Robert reports in 2026 and shows the year of his double RMD is the income that sets his Medicare premium in 2028. Cross $109,000 as a single filer or $218,000 married, and the surcharge kicks in. And it is not phased in. Go $1 over that line, and you owe the full surcharge for the entire year. somewhere between roughly $1,100 and nearly $7,000 extra per person, depending how far over you land. $1 over, full penalty. Think about the timing. In 2026, Robert takes an extension he thought was a favor. In 2028, long after he's forgotten this ever happened, a higher Medicare bill quietly shows up in his mailbox, and he has no idea why. By then, there's nothing left to undo. The income year is closed. The trap already sprung. And let me show you exactly what that Medicare surcharge looks like in real dollars, because IRMAA is a cold acronym until you see the number on the bill. In 2026, the standard Medicare Part B premium is $202.90 a month. That's what a retiree under the income line pays. But the moment Robert's income crosses that first threshold, his premium doesn't nudge up a few dollars. It jumps to $284.10 a month. That's more than $80 extra every single month on the Part B premium alone. Add the Part D surcharge stacked on top, and Robert's looking at roughly $1,100 more per year for the whole year, just for stepping $1 over a line he didn't even know was there. And remember, this is a married couple killer too. If Robert and his wife are both on Medicare, that surcharge hits each of them separately. 2 premiums, both jacked up because of one income spike in 1 year. And it's not permanent, which is the one small mercy. If his income drops back down the next year, the premium eventually comes back down too. But for that 1 year, it's locked in, and there is no appeal just because you didn't understand the rule. The IRS and Medicare don't grade on a curve. If a little knot just formed in your stomach because this sounds exactly like your situation, comment the word stacked below. I read them, and I want to see how many of you are sitting where Robert's sitting right now. So, how do you make sure you're never standing where Robert's standing? There are 3 moves here. All legal, all straightforward, and not one of them requires you to become a tax expert. But I want to show you what each one actually does to the numbers, because that's where it clicks. Move number 1 is the simplest, and honestly, it's the one most people needed to hear 2 years ago. Just take your first RMD in the year you actually turn 73. Don't wait for April. Watch what that does to Robert. If he'd taken RMD number 1 on time in 2025, then 2025 shows one withdrawal and we're there around $18,000 and 2026 shows the other $19,608. His combined income in 2026 lands near $50,000 instead of $70,000. He's still over the Social Security thresholds, yes, but he's nowhere near the 85% cliff getting hit at full force. And he's a country mile from that 109,000 IRMAA line. Same total withdrawals, same IRA. He just refused to let them pile into 1 year. That single decision is the whole ball game. The extension only becomes a trap if you reach out and take it. Move number 2 is for anyone who gives to charity anyway. And this one is quietly powerful. It's called a qualified charitable distribution, a QCD. Here's what it does that nothing else can. When you send money from your IRA straight to a charity, up to $111,000 a year, that transfer counts toward your RMD, but it never shows up as taxable income. It never enters the combined income formula. It never touches the IRMAA calculation. So imagine Robert gives $5,000 a year to his church. If he routes that $5,000 as a QCD instead of writing a personal check, he's satisfying part of his RMD and lowering the exact income number that decides how much of his Social Security gets taxed and whether he crosses that Medicare line. It's the only move that lets you satisfy the IRS and shrink your taxable income at the same time. One catch you have to know. A QCD only works from an IRA. It does not work from a 401k. So if most of your money is still sitting in an old workplace 401k, you'd need to roll it into an IRA first. before this door even opens. Move number 3 is the long game, and it's the one almost nobody uses in time. Roth conversions in the years before you turn 73. Here's the logic. Your RMD is calculated off your traditional IRA balance. Every dollar you move out of that traditional account and into a Roth in your 60s, in your early 70s, before RMDs even start, is a dollar that's no longer sitting in the pile the IRS divides up later. You pay the tax on the conversion now on your terms in a year you control, instead of getting the withdrawal forced on you later in a year that stacks. Convert enough over several years and you permanently shrink the base that every future RMD is calculated from. And here's a piece almost no one has caught up on. If you've got an old Roth 401k, the rules changed in 2024. It no longer requires RMDs during your lifetime at all, exactly like a Roth IRA always has. A lot of people are still taking withdrawals they no longer have to take. If even one of those 3 just made something click for you, do me a favor and hit the like button. It's the single thing that tells YouTube to push this in front of another person Robert's age before they take the bait. And subscribe, because next week I'm breaking down the widow's penalty. What happens to your tax bracket the year your spouse passes away, and why the survivor often ends up paying more tax on less income. If you're turning 73 this year or next, this decision isn't hypothetical anymore. It's sitting in front of you right now with a deadline attached. Call your IRA custodian this week. Ask them directly, what's my RMD deadline and what happens if I wait? Then get a real answer from a tax professional before December 31st makes the decision for you. Because once that calendar page turns, you don't get to undo the stack. The choice window closes the moment 2 RMDs are both locked into the same tax year. Drop your IRA balance in the comments, even a rough number, and I'll tell you approximately what your RMD stack would look like if you delayed versus if you didn't. I read every one. Let's go back to Robert. In one version of this story, nobody warns him. He takes the extension the 2 RMDs stack. $38,000 lands on one tax return. His Social Security gets pulled into the taxable zone. And 2 years from now, a Medicare bill shows up that he can't trace back to anything, but because by then he's forgotten this ever happened. In the other version, Robert watches this video in time. He takes RMD number 1 the year he turns 73. No stacking, no torpedo. No surprise letter in 2028. Same IRA, same 35 years of work. But this time, he keeps more of it. The IRS didn't do anything illegal here. That's what makes it dangerous. It's a real rule, sitting in plain sight, waiting for people to read extension and hear free. Now you know better. Make sure the people in your life turning 73 this year know it too.